The world once again finds itself gripped by a familiar sense of unease. Tensions in the Middle East have escalated into open conflict. The Strait of Hormuz, a narrow passage through which nearly 20% of global oil supply flows, now sits at the center of geopolitical risk. Any disruption, or worse, closure, would not merely be a regional issue. It would send shockwaves through global energy markets. And the market has responded accordingly. Oil prices have surged past $100, supply chains are being questioned, and the narrative is quickly turning apocalyptic. Inflation fears are resurfacing, recession warnings are being revived. Across financial media and YouTube, the tone has shifted from optimism to anxiety, from growth to survival. For investors in technology, particularly those exposed to AI hyperscalers, Google, Microsoft, Amazon, and Meta, the concern feels especially acute. These companies are energy-intensive, capital-heavy, and deeply tied to global supply chains. As prices fall and uncertainty rises, a natural question emerges. Is this the beginning of a deeper structural breakdown? Hi, I'm Freeman. I'm an investor focused primarily on U.S. technology, especially the companies driving the AI transformation. Like many others, I've seen my portfolio come under pressure during this recent bout of market turbulence. Friends have asked me whether rising oil prices fundamentally change the investment case for hyperscalers, whether this is the moment to step aside before things deteriorate further. At the same time, many voices online are painting an almost apocalyptic picture, suggesting that an oil shock of this magnitude could derail the AI boom altogether. My own view is more measured, not dismissive of risk, but more nuanced in how that risk is likely to unfold. I do not believe the impact of rising oil prices on hyperscalers is direct or immediate. Rather, it is layered, indirect, and often misunderstood. To make sense of it, we need to move beyond the headlines and examine carefully how the effects of the Middle East crisis may be transmitted to the hyperscalers through several distinct layers. Layer 1. Direct impact on operations. At first glance, the concern appears straightforward. Hyperscalers operate massive data centers. These facilities consume enormous amounts of electricity. If oil prices rise sharply, shouldn't operating costs rise as well? The intuition is understandable, but it is incomplete. Hyperscalers do not run on oil. They run on electricity, and that electricity is delivered primarily through local power grids. While companies such as Google, Microsoft, Amazon, and Meta increasingly supplement their energy sourcing through renewables, long-term contracts, and even direct infrastructure investments, the local grid remains the primary channel of delivery. The critical question, therefore, is not whether they consume energy, but what drives the generation of that energy. In key hyperscaler regions, particularly the United States, electricity generation is dominated by natural gas, alongside renewables and nuclear energy. Oil plays only a minimal role. This distinction fundamentally changes the equation. Oil is globally traded and highly sensitive to geopolitical disruptions, such as a potential closure of the Strait of Hormuz. Natural gas in the United States, by contrast, is largely domestically produced and regionally priced. The United States is a major natural gas producer and a net exporter, supported by abundant shale resources. As a result, while oil prices have surged significantly, U.S. natural gas prices have remained relatively stable, hovering around $3 to $4 per MMBtu. This divergence is crucial. It means that the primary driver of electricity costs for hyperscalers is not directly linked to global oil price volatility. In addition, hyperscalers are not passive consumers of energy. They actively manage their energy exposure through long-term power purchase agreements, often spanning 10 to 25 years, locking in electricity prices from renewable sources such as solar and wind. Increasingly, they are also entering agreements involving nuclear and other stable energy sources, further reinforcing cost predictability. Taken together, these factors significantly limit the direct transmission of oil price shocks into hyperscaler operating costs. This does not mean energy is irrelevant. As AI workloads expand, power demand will only grow more important. But under the current scenario, oil price increases alone do not materially threaten data center operations. The first layer, therefore, is far more resilient than it appears. Layer 2, semiconductor supply chains. If the direct operational impact is limited, the second layer presents a more credible channel of risk. The AI ecosystem is ultimately dependent on semiconductors, advanced GPUs, high bandwidth memory, and complex packaging technologies. These critical components are overwhelmingly manufactured in Asia, particularly in Taiwan and South Korea, making the supply chain geographically concentrated. Unlike hyperscaler operations in the United States, these regions rely heavily on imported liquefied natural gas, or LNG, for electricity generation. This dependence exposes them more directly to global energy market volatility. As a result, disruptions in energy supply, especially those linked to geopolitical tensions in the Middle East, can transmit into the semiconductor ecosystem through a more indirect but meaningful pathway. Energy disruption drives up LNG prices, which in turn increases electricity costs, thereby exerting upward pressure on semiconductor production costs. However, the magnitude of this effect must be kept in proper perspective. Energy typically accounts for approximately 5% to 15% of total semiconductor manufacturing cost, with the majority driven by capital-intensive equipment, materials, and process complexity. Even significant increases in electricity prices would therefore translate into only moderate increases in overall production cost. A more immediate concern lies in material supply. Semiconductor manufacturing depends on a range of specialty gases and chemicals, some of which have highly concentrated supply chains. Helium is a notable example, with approximately 25 to 30% of global supply originating from Qatar. Disruptions to Middle Eastern logistics could tighten supply availability and increase input costs. Fortunately, the system contains built-in buffers. Semiconductor fabs and industrial gas suppliers typically maintain inventory levels sufficient for several weeks to a few months, depending on the material and contractual arrangements. In addition, global suppliers such as Air Liquide and Linde operate diversified supply networks that allow for the reallocation of materials across regions. While these mechanisms do not eliminate disruptions, they significantly reduce the likelihood of immediate production shutdowns. The more probable outcome is not collapse, but increased friction in the form of tighter supply, incremental cost increases, and longer lead times. At the same time, semiconductor manufacturers actively manage these risks through long-term supply agreements, supplier diversification, and process optimization. Increasing adoption of recycling systems, particularly for gases like helium, further reduces dependence on fresh supply and enhances resilience. On the demand side, hyperscalers are also partially insulated. They secure semiconductor supply through multi-year contractual arrangements, including capacity reservations with foundries and memory suppliers. These agreements provide priority access in an already constrained market, offering meaningful buffering, though not complete immunity, against supply disruptions. The second layer, therefore, represents a genuine but contained risk. It introduces friction into the system, but not structural failure. Layer 3, macroeconomic impact. The third layer is where the impact becomes more significant. An oil price shock does not need to directly increase data center costs or halt semiconductor production to affect hyperscalers. Its most powerful effect is through the broader economy. Rising oil prices can feed into global inflation by increasing transportation and production costs. This, in turn, can affect consumer behavior, business spending, and monetary policy. If the crisis persists, it could contribute to slower economic growth or even recessionary conditions. For hyperscalers, the key transmission channel at this level is demand. Companies such as Alphabet and Meta derive a substantial portion of their revenue from advertising, which is highly sensitive to economic cycles. In a weaker economic environment, businesses tend to reduce advertising budgets, leading to slower revenue growth. In contrast, cloud and enterprise segments, particularly those of Microsoft, Amazon Web Services, and Alphabet, exhibit greater resilience. Investment in cloud infrastructure and artificial intelligence is increasingly regarded as strategic rather than discretionary, rendering it less susceptible to short-term economic fluctuations. This reflects a broader structural shift. AI investment is becoming semi-inelastic. Unlike traditional IT spending, which can be deferred during downturns, AI adoption is increasingly driven by competitive necessity. Companies invest in AI not merely for growth, but for efficiency, cost reduction, and long-term positioning. As a result, even in a weaker macro environment, AI-related spending is likely to continue. This creates a balancing effect. While certain revenue streams, particularly advertising, may face cyclical pressure, AI-driven demand continues to provide structural support. From a market perspective, the more immediate impact is likely to be valuation compression. Higher uncertainty and potential changes in interest rate expectations can lead to lower valuation multiples, particularly for growth-oriented companies. The extent of this effect depends on the duration of the crisis. Importantly, hyperscalers enter this environment with strong financial positions, robust cash flows, significant liquidity, and relatively low leverage. This allows them to continue investing in AI infrastructure even during periods of economic stress, reinforcing their competitive advantage. The third layer, therefore, represents cyclical pressure rather than structural damage. In conclusion, when viewed across all three layers, a clearer picture emerges. The direct impact of oil prices on hyperscaler operations is limited by the structure of electricity generation and long-term energy procurement. The semiconductor supply chain faces real but manageable pressures, with buffers, contracts, and operational strategies mitigating the risk of severe disruption. The most significant impact lies in the macroeconomic environment, where slower growth and reduced spending may weigh on certain revenue streams and valuations. However, none of these factors point toward an existential threat. There will likely be periods of volatility. There may be revenue softness, particularly in advertising. Valuation compression is possible, especially if uncertainty persists. But these are cyclical effects, not structural breakdowns. At the same time, the underlying driver of hyperscaler growth, the expansion of artificial intelligence, remains intact. AI continues to penetrate deeper into business operations and everyday life. The incentives for adoption, centered on productivity and competitive advantage, remain strong. In this context, the current crisis appears less as a breaking point and more as a test of resilience. Markets react fast, reality moves slower, and sometimes that gap is where opportunity lies. And of course, these views represent my personal perspective as an independent investor. They are not financial advice, nor a recommendation to buy or sell any securities. I encourage you to do your own due diligence and make decisions that align with your own risk tolerance and investment objectives. Thank you for watching. Goodbye, and have a great day.